You know the image, right? When we picture the ultimate financial dream, it almost always looks exactly the same.
Oh, absolutely. Sitting on a beach somewhere.
Right? You're on a beach or, maybe just relaxing on your porch on a Tuesday afternoon and your phone buzzes.
Uh-huh.
You look down and it's a notification from your brokerage app. A dividend payment just hit your account.
The dream.
Exactly. The dream of passive income, making money while you sleep. I mean, it feels like the ultimate hack to life, like this permanent stream of wealth just being generated for you.
It really does feel that way.
But what if that notification, that feeling of creating new money out of thin air, is actually just a mathematical illusion? We are tackling a massive question today, probably the single most pervasive debate in personal finance. Do dividends and investment yields actually create wealth for you? Or do they just, move your own money from one pocket to another while making you feel richer?
I mean, it is a question that challenges the entire foundation of how most people build their retirement portfolios.
Yeah.
The idea of living off yield is deeply, deeply ingrained in investor culture. But the mechanical reality of what happens behind the scenes is, well, it's widely misunderstood.
So to settle this debate, we're diving into an advanced economic report today. It's titled Proventos em Investimentos, which translates to investment dividends or earnings.
Right?
And this was published just yesterday, April 17, 2026. It's a super comprehensive analysis covering the economic, accounting, tax, and even the behavioral realities of living on yield in the Brazilian market.
It's a fascinating read.
Yeah, and by the end of this deep dive, you are going to look at your portfolio's cash flow through a completely different lens. So let's start with the most basic assumption. People have this idea that a dividend is essentially free money falling from the corporate sky.
Right, the idea that the company just hands you cash and your stock just keeps trucking along like nothing happened.
Exactly. But what is actually taking place on the company's balance sheet when that cash gets distributed?
Well, we really have to look at the strict accounting reality here. I mean, a publicly traded company has assets, right? And cash is obviously one of those assets.
Makes sense.
So when a company decides to pay a dividend, it is taking cash directly out of its own corporate bank account, cash that, contributed to the total overall valuation of the company.
Okay.
And it hands it out to the shareholders. Because the company now physically has less cash on its balance sheet, the company is objectively worth less. The market adjusts for this capital outflow immediately.
Wow. So if I hold a share of that company, my piece of the pie hasn't actually grown at all.
Not even a little bit.
It's like slicing a piece off a pizza I already own. Like I have a slice in my hand, but the whole pizza is sitting in the box on the counter is now definitively smaller.
That is the perfect analogy. You didn't magically get more food just because you separated the slice from the pie.
Right.
You did not get richer. Your total wealth remains static. It just changed shape. The report uses a really clean numerical example to illustrate this ex-dividend drop.
Let's hear it.
Let's say you own a stock priced at 25 rays. The company announces it's paying a 1.50 dividend per share. On the exact day that stock trades ex-dividend, meaning anyone buying it that morning no longer gets the dividend, the theoretical price of the stock drops instantly and automatically to 23.50.
Okay, so you now have an asset worth 23.50 and you'll get 1.50 in cash.
Exactly.
But wait, who actually enforces that? Like if a stock is trading at 25 on Tuesday and goes ex-dividend on Wednesday, why doesn't it just open at 25 on Wednesday? Is there like some guy at the stock exchange manually changing prices on a chalkboard?
No. It's enforced by the brutal efficiency of the market, specifically through arbitrage.
Arbitrage.
Yeah, think about what would happen if the price didn't drop. If the stock stayed at 25, high-frequency traders and these massive hedge funds would just buy millions of shares the day before the dividend.
Oh, and then just collect the free 1.50 per share.
Exactly. And then they would immediately sell the stock the next day for 25. They would drain the company of its cash with literally zero risk.
Oh, well. Yeah, that makes total sense. The market isn't going to just leave free money lying on the table for traders to exploit like that.
Right. So to close that free money loophole, the market instantly marks the underlying asset down by the exact amount of the dividend paid. It is a strict value transfer.
Okay, but the report does point to a famous 1970 study, right?
Yeah.
By Elton and Gruber.
Yes, the Elton and Gruber study.
And they showed that in the real world, the price drop isn't always a perfectly clean 1-to-1 ratio. Like a 1.50 dividend might only result in a 1.30 drop in the share price. Why is that?
That discrepancy is almost entirely due to taxes. In most markets, different investors pay different tax rates on dividends versus capital gains.
Oh, right. Like a regular retail investor pays one rate, But a massive pension fund pays something completely different.
Exactly. And this creates friction because the market is just this chaotic aggregate of all these different players with different tax liabilities. The exact pricing of the drop gets a little muddy. But Elton and Gruber's core finding still confirmed the accounting principle. Paying a dividend definitively reduces a company's equity. It does not create value out of thin air.
So if the math proves that dividends are literally just moving my own money around, forcing my asset to shrink so my cash balance can grow, why is the entire market so obsessed with them?
It's a great question.
Like, why would investors prefer to just hold the whole pizza and let the company reinvest that cash to grow the business?
Well, the answer is that in the real world, the value of a dividend doesn't come from the creation of new money. The value lies entirely in how that money is, or more importantly, isn't taxed.
Okay. The taxes.
Yeah, we have to look at the tax landscape because this is where the theoretical math collides with government policy.
Let's break down the Brazilian tax reality then, because heading into 2026, things have been incredibly volatile.
Oh, extremely volatile. Let's look at the baseline right now in April 2026. The major shift happened with Lei 15.270 back in 2025, the income tax reform.
Yeah.
This law instituted a tax on dividends, but it included a massive carve-out. It only taxes dividend amounts above 50,000 reais a month per CNPJ.
Wait, per CNPJ, so that means the threshold applies per registered business or corporate entity, not necessarily per individual person.
Correct. It applies to the legal entity receiving the funds. But, for the vast majority of everyday retail investors, generating 50,000 reais in monthly dividend income is just far beyond their portfolio size.
Yeah, definitely.
Meaning they remain completely exempt from that specific dividend tax. However, the real drama and what the researchers flag as a massive systemic risk centered around Medida Provisoria 1.303.
MP 1.303, also introduced in 2025, right?
Yes, this provisional measure proposed ending the historic tax exemptions for FIIs, which are real estate investment funds,
Right?
as well as fixed income instruments like LCIs and CRIs, which are tied to real estate and agribusiness loans.
I mean, those specific assets are the absolute darlings of the Brazilian retail investor. People build their entire 30-year retirement strategies around those tax-free monthly payouts. If you kill the tax exemption on a real estate fund, you completely change the math of middle-class retirement in Brazil.
Which is exactly why there was such a massive uproar. And here is the crucial update from the report. Congress officially rejected MP 1.303 in October 2025.
So it didn't pass into law.
No, it did not.
Yeah.
So heading into 2026, the exemptions for FIIs, LCIs, CRIs, and CRAs are fully maintained. The tax haven survived the assault.
Okay, but let's pause and look at the bigger picture here for a second. If the government explicitly tried to tax FIIs and LCIs with this measure, and they only failed because Congress voted it down at the last minute,
Yeah.
doesn't that mean this entire tax haven is perpetually at risk?
Yeah.
I mean, the report explicitly flags this as a regulatory vulnerability.
Right.
Are investors basically building a decades-long compounding strategy on a foundation of thin ice?
It is a profound risk, and investors routinely underestimate it. The government clearly signaled its intent to capture that revenue.
Right.
Just because the measure was rejected in 2025 doesn't mean the political desire to tax these instruments just evaporated. When you look at an FII yielding an attractive tax-free return today, you are getting a real economic benefit.
Because you're keeping money the government would otherwise take.
Exactly. But you must mentally price in the reality that the tax-free part of that equation is written in pencil. If that exemption disappears in 3 years, the compounding math on your entire wealth-building strategy shatters overnight.
That is a really harsh reality to swallow. But okay, let's say the tax exemptions hold. Let's say the rules don't change. The report highlights another massive issue.
Yes, the behavioral trap.
Yeah, even when the tax breaks are real, our own brains are hardwired to misunderstand what's happening. We fall into these traps that cause us to basically destroy our own wealth.
The psychology of yield is fascinating, and it's often super destructive. The report cites Richard Thaler and Hersh Sheffrin, who are two pioneers in behavioral economics. They studied a concept called money illusion. They demonstrated that receiving physical cash in an account provides this tangible psychological thrill. It triggers an actual dopamine hit.
Whereas watching a stock's underlying price tick upward on a screen by the exact same amount does not provide that same neurological reward.
Exactly. Even though the mathematical outcome to your net worth is completely identical. A 100 real stock growing to 105 versus a 100 real stock dropping to 100 and handing you 5 rees in cash.
The brain processes those two scenarios completely different.
Completely differently. And because of this money illusion, investors engage in what behavioral economists call mental accounting.
Like partitioning their money into imaginary buckets.
Yes, they view the original investment as principal, a sacred bucket that should never be touched or sold. But they view the dividend as income, a separate bucket that is free to be spent.
Ah, I see.
So they eagerly take their dividends and spend them on vacations or new cars or whatever. What they fail to realize is that mathematically, because of that ex-dividend price drop we discussed earlier, they are slowly consuming their own capital.
Wow. So with that mental accounting, investors are essentially tricking themselves.
Yeah.
And that psychological blind spot leads directly into what the researchers call the dividend yield trap, right?
Yes. The yield trap is where portfolios go to die.
Ouch.
Seriously. If you are listening to this and you have your retirement pegged to a stock and your brokerage app boasting like a massive 15% dividend yield, you need to pay close attention.
Because the behavioral brain sees that 15% and lights up. Wow, a 15% return in pure cash. This company is a cash machine.
Exactly. But you have to remember how yield is actually calculated. It is a simple ratio. It's the dividend paid over the trailing 12 months divided by the current stock price.
Which means there are two ways a yield can go up. The company can either increase the dividend payout or
The stock price can crash. Precisely. In the Brazilian market, a yield above 12 to 15% often signals severe financial distress, not corporate generosity.
meaning the market has panicked.
Exactly. Institutional investors have dumped the stock, causing the denominator of the stock price to plummet. The dividend in the numerator might reflect last year's record profits, but the stock price is reflecting today's existential crisis.
So if I see a 15% yield, I shouldn't be thinking, look how generous this management team is. I should be asking, what disaster just happened to their core business, and why is the market pricing this company for bankruptcy?
Yes, that is the exact question you should ask. The report cites Oswath Damodaran, the valuation expert from NYU Stern, who specifically warns against this.
What does he say?
Well, he notes that the classic dividend discount model, which values a company solely based on projecting its future dividends to infinity, is really just a heuristic. It's a mental shortcut.
And I'm guessing it frequently fails for volatile Brazilian companies?
It does. Assuming a company paying a 15% yield today will keep paying it next year in an economy driven by volatile commodity cycles and shifting inflation, I mean, that is a fatal assumption.
It's incredible how our brains just want the simple story, like high yield equals safe harbor. But while the dividend trap is about investors tricking themselves, the report highlights another area where the financial product itself is essentially wearing a disguise.
You're talking about amortizations.
Yes. I want to talk about amortizations because this feels like accidental capital consumption on a whole different level.
It really is. This is a critical distinction for anyone holding CRAs and CRA certificados de recebíveis imobiliarias and do agronegocio.
Right. These are the debt instruments where you're basically lending money to the real estate or agribusiness sectors.
Exactly. They are massively popular because they provide regular tax-free payouts. But retail investors have a major blind spot here. They fail to distinguish between income and amortizations.
Let's define the mechanics of that, because this honestly blew my mind when I read it.
So when a CRI pays you a coupon, that represents the interest on the loan. That is your actual yield, your income.
Okay.
But many of these instruments are structured to also pay amortizations along the way. And amortization is simply the borrower returning a piece of your original principal.
They're just paying back the actual loan amount.
Exactly.
So if I take an amortization payment and treat it like income, like if I use it to buy groceries or pay my electric bill, it's basically like chopping up the floorboards of my house to use as firewood to stay warm.
Yes.
I mean, it works for a little while. I'm warm today. But eventually, I won't have a house left to live in.
That is exactly what is happening. Let's say you get a 1,000 real monthly payout from a CRI. You think, great, my passive income arrived.
Right.
But if 800 reais of that is amortization and only 200 reais is interest, and you spend the whole 1,000, you just ate your own principal.
You're systematically liquidating your own investment.
Exactly. Your overall wealth is shrinking every single month. But because the cash arrives via an automated deposit, the money illusion tricks you into feeling financially secure.
That is a brutal realization. You think you're generating passive income, but your portfolio is actually on life support. And if amortizations are the silent killers of principal, The report then hits us with the silent killer of compound interest, the cum codas.
Ah, yes. The cum quotas. It literally translates to quota eater.
Such a great name.
It's very descriptive. This is a tax mechanism specific to fixed income and multi-market mutual funds in Brazil. Unlike a regular stock where you only pay capital gains tax when you finally sell the asset.
Right.
The cum quotas forces you to pay taxes on your gains every 6 months in May and November automatically.
Like, the government doesn't even wait for you to click sell. They just reach into your account and deduct the quotas.
They do.
Why is this specific mechanism so destructive over the long term, though?
Because it interrupts the mathematical miracle of compound interest.
Yeah.
To really grasp the magnitude of this, let's just run a quick simulation.
Let's do it.
Imagine you have two identical portfolios, each starting with 100,000 raise, and both earn 10% a year.
Okay.
Portfolio A is a tax-deferred asset. Portfolio B is a fund subject to the 17.5% cum quotas.
Got it.
In year one, both portfolios gain 10,000 raise. But in Portfolio B, the government swoops in and takes 17.5% of that gain, which is 1,750 raise.
So entering year two, Portfolio A has 110,000 raised to compound, but Portfolio B only has 108,250.
Exactly.
I mean, that doesn't sound like a massive difference in year two.
It doesn't, but roll that forward 10, 15, 20 years.
Yeah.
In Portfolio A, the untaxed gains are generating their own gains. The snowball is getting massive.
Right, the compounding effect.
But in Portfolio B, the government is essentially shaving the snow off your snowball every 6 months. Over a 20-year horizon, the sheer amount of lost compounding money you never made because the capital was extracted prematurely creates a massive chasm in final net worth. The cum quotas severely handicaps your long-term wealth compared to holding an equivalent tax-deferred asset.
Okay, so if dividends are often behavioral illusions, and amortizations trick you into eating your principal, and forced payouts trigger taxes that destroy compound interest, is there a mathematically superior way to generate cash flow?
To answer that, the researchers actually take us back to 1961 to one of the most famous theoretical models in financial history.
Oh, the Modigliani-Miller theorem. Really.
Yes, the theorem of dividend irrelevance.
1961, Modigliani and Miller. If I remember correctly, their whole premise was based on a frictionless, perfectly efficient world. Did they basically argue that if a company doesn't pay a dividend, an investor can just create their own dividend out of thin air?
That's exactly it. They proved mathematically that in a perfect world with no taxes and no transaction fees, corporate dividend policy is utterly irrelevant.
Okay.
If you own a stock and you want cash, you don't need the company to declare a dividend. You can just sell a small fraction of your shares.
Right. If you own 10,000 Ries worth of stock, selling 100 Ries worth of shares is mathematically identical to receiving a 100 real dividend.
In both cases, your equity drops by 100 and your cash increases by 100.
Okay, I get the math. But let's be real. Psychologically, logging into a brokerage app, actively deciding to sell shares of a company you believe in, paying the exchange fees. Now, this feels like failure to a lot of investors.
Oh, it really does.
They want to hold the asset forever and let the company do the work of sending the cash. Does the report address the friction of manually selling your winners?
It does, and it totally acknowledges that the psychological barrier is immense. It feels counterintuitive to sell the golden goose. But we have to look past the psychology and look at the tax code.
Right.
We don't live in Modigliani and Miller's perfect, frictionless world. We live in a world governed by taxes. So how does their theory apply to the Brazilian reality in 2026?
Because taxes dictate actual returns.
Exactly. In Brazil, there is a capital gains exemption if you sell less than 20,000 reais a month in regular stocks. So if you need cash to live on, selling a small slice of your portfolio is entirely tax-free up to that 20K limit. Now think about a long-term investor holding for 20 years.
If you hold an asset that does not pay dividends, your wealth grows internally, entirely shielded from taxes, until the day you finally decide to sell.
Yes.
And by deferring those taxes for 20 years, you're essentially getting a massive interest-free loan from the government to supercharge your compounding.
Precisely. The report contrasts two specific treasury assets to really hammer this point home. The NTNB principal versus the NTNB with semi-annual interest. Both are government bonds linked to inflation.
And the NTNB with interest pays you a cash coupon every 6 months, right?
It does. But every time it pays you, you get hit with income tax on that coupon. Furthermore, you now have a pile of cash sitting in your checking account that you have to figure out how to reinvest.
Which introduces reinvestment risk. If I don't actually need that cash today to pay my mortgage or buy groceries, getting that coupon is actually a burden.
It really is.
It forces me to go back into the market and find a new place to put the money, potentially at a much worse interest rate than I originally had.
It's a massive burden. You are forced to reinvest at the prevailing market rate, which might be significantly lower than the yield you locked in years ago.
Right.
Conversely, look at the NTNB principle. It pays zero coupons. All the interest rolls up internally.
So the compounding is mathematically superior because you never interrupt it with taxes.
And you never face reinvestment risk until the bond matures. You let the asset do the heavy lifting.
It is such a counterintuitive way to view cash flow. We are so conditioned to want the payout, to want the notification on our phones. But the math tells a totally different story.
It really does.
So what does this all mean? When we synthesize the accounting, the behavioral traps, the taxes, and the compounding math, what is the final verdict from this report on our central question?
The conclusion the researchers arrive at is unequivocal. Dividends and yields fundamentally are not magic wealth creators. They are value transfers.
Value transfers.
Yes. They only truly create value for the investor under two very specific, rigorous conditions. First, if there is a distinct tax advantage, like the current exemptions for FIIs and CRIs that allow you to legally keep money the government would otherwise extract.
Okay, and the second.
Second, if the investor has the ironclad discipline to immediately reinvest those dividends, utilizing the cash flow to buy more assets over time rather than spending it.
Right.
If you are just blindly consuming your portfolio's cash flow because it feels like free money, you are often just slowly draining your own net worth.
It is a massive mindset shift. Instead of asking, how much yield does this pay? Well, investors really need to ask, how is this yield being taxed? What is it doing to my underlying principal?
Exactly.
Well, before we wrap up, I have to share a quick mandatory disclaimer that is explicitly required by the authors of the source document.
Go for it.
This deep dive is purely for informational and educational purposes. It contains no ideological bias whatsoever and absolutely does not constitute financial, legal, or investment advice. Projections and tax laws, as we saw with the intense political drama around MP 1.303, are subject to frequent and sudden changes. And of course, past performance is no guarantee of future results. You should always consult with a registered professional before making investment decisions.
That context is vital, especially considering how rapidly the regulatory environment can shift beneath our feet.
It really is. But I want to leave everyone with one final provocative thought from the report to mull over. We spent a lot of time today talking about building a retirement strategy.
We did?
A lot of investors, both in Brazil and globally, use the famous safe withdrawal rate, often referred to as the 4% rule.
Oh, right. The Trinity University study and William Bengen's research from the 1990s?
Yeah, which essentially theorized that if you withdraw 4% of your portfolio's initial value every year, adjusted for inflation, you'll practically never run out of money over a 30-year retirement.
It is the golden rule of thumb for the global FIRE movement. Financial independence, retire early.
But the report drops a massive glaring warning right at the end. That 4% rule is based entirely, 100%, on United States market data.
That's a huge caveat.
It is. The U.S. has a very specific history of inflation, currency stability, and equity returns. The researchers note that there is absolutely no robust statistical equivalent verifying that the 4% rule works for the Brazilian reality.
Oh, wow.
So the question we have to ask ourselves is, are Brazilian investors blindly trusting an imported retirement formula that might completely collapse in a much more volatile, high-inflation emerging market environment?
It's a chilling realization. I mean, if you are banking on a 4% withdrawal rate in a market driven by commodity shocks and double-digit interest rates, a market that behaves very differently than the S&P 500, the imported math might not save you when things get rough.
It definitely makes you rethink that picture of sitting on the beach, waiting for the phone to buzz.
It really does.
Is that notification truly a permanent stream of passive income? Or is it just a tiny piece of your own pizza being handed back to you right before the tide rolls in and the tax laws change? Keep that in mind next time you check your portfolio. Thanks for joining us on this deep dive.